What's up, everybody? Dan again, stocktrades.ca. I'm pretty excited for this video. We're going to divert from what we've been typically doing the last couple of weeks, which is dividend related content. And instead, I'm going to come back to two stocks that I suggested that Canadians avoid back in August, that being Cineplex and Air Canada. So has my opinion changed on these two companies, or do I still believe that they are two options that Canadians should really be avoiding moving forward? Let's get started. So for those who remember the video, it was way back in August of 2020, and I posted a video suggesting that investors stay away from companies like Sienna Senior Living and Cineplex. Now, I'm not going to go over Sienna Senior Living in this video. I'm instead going to go over Air Canada, but there was a lot of heat that I took from this video on Cineplex because people still felt that it had value in today's environment. And I know I'm going to get a lot of comments after this video stating, hey Dan, Cineplex has gained 35.5% since you published that video in August. But I'd just like to quickly highlight here that not only was I a bear on Cineplex, I was also relaying better stocks to Stock Trades Premium members. And if we look to this chart here, Sienna Senior Living and Cineplex, our pick during the time of that video has outperformed these two stocks considerably, returning 102%. And if we look to our pick just a few short weeks later over at Stock Trades Premium, it is returning 40.3%, while Cineplex and Sienna are returning around 21.4% and 20%. So I know people would like to say that Cineplex has gained 35%, but the fact is we've been able to identify better options than Cineplex, and as a result, I really feel that there still is better options than Cineplex moving forward. So with that being said, let's look into the company right now and why I feel it is something that investors should still avoid moving forward. So what exactly is Cineplex? They are one of the largest theaters in Canada. They had over 70 million guests per year on average, and they employed over 13,000 people. The company is also engaged in esports with its World Gaming Network, as well as entertainment centers like Palladium. And most recently, the company decided to essentially branch out and start what we call the Rec Room, which is essentially like an arcade restaurant style facility. And prior to the pandemic, the company was actually doing a pretty good job at venturing away from being a pure play cinema company, and the Rec Room came of this. But it was just a little too late for the company because the pandemic hit and the acquisition of Cineplex by Cineworld ended up falling out, and its share price essentially collapsed. So why exactly are investors flocking to companies like Cineplex? Well, for one, they pretty much have a monopoly here in terms of cinema in Canada. There isn't really another company that is as dominant as Cineplex. I mean, we saw over 70 million guests. So it's somewhat of a recognizable brand, and it's also the thesis that theater will eventually come back. Movies will come back. People will start to go to the theaters again. And while this is correct, it doesn't necessarily have to be Cineplex that is bringing the experience to Canadians. This is a company that is in horrible financial shape right now, and they could be prone to a takeover offer, which could end up in them selling their assets for pennies on the dollar. So, to a lot of watchers, the viewers, and readers on our website, they think I'm essentially picking on Cineplex because of the pandemic. But this is a stock that I never liked. I didn't like this stock pre-COVID. And the reasoning for this is there is absolutely no doubt that cinema traffic was falling prior to COVID. In fact, if we look at a few reports, in 2017, there was a report out that domestic movie theater attendance in the United States had hit a 25-year low. And to follow that up, in 2019, the year before COVID-19, US movie ticket sales fell a further 5%. I knew the warning signs were there prior to COVID-19, and there's even more warning signs now. Two of the key factors in the the cinema industry suffering before COVID-19 was the fact that it is very expensive to go to the theaters. I loved going to the theaters, but we limited our trips to the movie theater because it is very routinely a $40, $50, $60 cost to head to the movies. And especially moving forward in a recessionary environment, people just don't have that kind of money. And secondly, the advancements in technology have made home theater ridiculously easy for essentially a Canadian of any income level to have. I mean, you can buy 70-inch flat screens from discount brands that are high quality, much higher quality than you've seen in discount brands prior, for pretty crazy prices. So people can put a home theater system in, a solid 70-inch TV, and a pretty good sound system in for under $1,000. I personally know some people who have set themselves up for under that price point. So it's way easier to get that kind of experience at home. And streamers are understanding this. That is exactly why they're starting to take, in the United States, new movies and air them on HBO Max as soon as they go into theaters. They're trying to see that if the stay-at-home cinematic experience is going to drive them more revenue than people going to a theater. And I really think it is going to. And as a result, I would expect this to make its way up to Canada pretty soon. So if we move on from my bearish thesis and instead just get down to the straight fundamentals, Cineplex is a company that is in horrible financial shape. Prior to the pandemic, Cineplex had experienced somewhat flat box office revenue for the better part of 5 years, and this was a warning sign in and of itself. However, many investors ignored this, then were again blindsided by a failed acquisition attempt by Cineworld, which essentially officially collapsed this company's share price. Fast forward to 2020 and we have the pandemic. It has destroyed this company's balance sheet and their financial position. So as of its most recent filing, Cineplex currently has a current ratio of around 0.238. And what this suggests is that the company has 4 times the liabilities due in the next year than it does liquid assets to pay for them. So this isn't an exact to a T example because I'm going to speak on a monthly basis here, but it really gives you the financial situation that they're in. It would be like you having $400 for your rent that is $1,600 a month. What are you going to have to do to pay that rent? You're going to have to borrow money from somebody else or find some other way to come up with that initial capital. Now, another thing about Cineplex's balance sheet is most of its current liabilities come from what we call deferred revenue, which essentially means that Cineplex has been paid already for a service that is going to provide in the future. So Cineplex in the future is going to be providing services that it is not going to receive revenue for. This is something to take into consideration as well. So one of the more important things to consider with these financial statements is this is only from September 30th. That's the last time they filed earnings. So something really important happened between September 30th and when Cineplex is going to file their next quarterly report. And that is we had a huge second wave of shutdowns here in Canada. In Alberta here, it started in late December, but in Ontario, much of them were shutting theaters down in November. So I would expect Cineplex's earnings to be even weaker when they file next quarter's report. So overall, I'm just not really a big fan of this company. I wasn't a fan of this company pre-pandemic, and I really think they're going to underperform moving forward. Even though their share price is depressed right now and we could see an increase based on reopening, I really think that as Canadians, we should be investing in newer, more disruptive industries and avoiding value traps like Cineplex is presenting right now. This company's popularity and revenue were decreasing pre-pandemic. My bear thesis is not just based on how badly they've been affected by the pandemic. Much like the shift from fossil fuels to renewable energy, I really think investors should be shifting out of companies like Cineplex, which I feel is not only a mature industry, but a declining industry, the cinema industry. We should be eyeing more disruptive industries, ones that not only are growing in total size, but companies we can see that can capture more market share inside of these industries. So just to pause the video, and it's really important, I want you to to head down below and let me know what you think of Cineplex. I know there are some very conflicting opinions on this company, and I want to know what you feel about my opinion on the company and what you feel about Cineplex and the cinema industry in general moving forward. And again, if you like the video, smash that like button and subscribe to the channel. It helps us bring you more great content. But let's move on to the next very popular Canadian stock that I want to talk about today, and that is Air Canada. So getting this out of the way early, I do feel a lot better about a company like Air Canada than I do Cineplex, but there is no doubt that Air Canada has been materially impacted by the COVID-19 pandemic, the second wave of shutdowns, and ultimately, even from the company themselves, they state they likely won't return to 2019 revenue for 3+ years. So this is a company that is going to take a significant hit moving forward, and it is adding a lot of debt to the balance sheet and currently bleeding a lot of money. And this isn't actually the first time that a company like Air Canada has been in hot water. If we look to its chart, we can see that this company collapsed during the financial crisis and failed to recover for 2 to 3 years' time, as the company came very, very close to going through bankruptcy protection again in late 2012. But this is not a company that is a stranger to bankruptcy protection. It went into it in 2003. But after 2012, the company got its affairs in order and it became one of the best performing stocks on the TSX index, going from $1 a share to over $50 prior to the COVID-19 market crash. So what a lot of investors are wondering right now is this a company that is on the verge of bankruptcy yet again, or are they going to be a value play essentially because of depressed share levels right now because of COVID-19 in the future? And for me, it's really mixed reactions on Air Canada right now. I don't think the company is going to go bankrupt. I think they are in a financial position to weather this storm and continue to weather this storm. But there is no question that the overall debt levels added to the balance sheet and the leverage that this company has had to undergo is going to affect them in the mid to long term. So the company is probably close to posting fourth quarter earnings pretty soon. So all I have to look at right now is the third quarter earnings report, which is pretty bad. And it gave us a true glimpse of how badly this company is hurting due to the pandemic. The company reported that overall traffic is down by 88%, and the company had posted a loss per share of $12.58 through the first 9 months of 2020. And yes, you read that right. That is a loss per share of over $12.50. This is a drastic change from the near $5 earnings per share that Air Canada posted in 2019. So if we look to the balance sheet and we look on the debt side of things, the company has added over $3.05 billion in long-term debt and now holds over $13.2 billion in total debt, 2 of which comes due in the next year. Now, there are some industries that typically have higher debt. I mean, we can look to a telecom like TELUS, who has nearly its market cap in long-term debt, but this is a completely different industry. So obviously, for a company that is adding this much debt, they're having to issue shares like we saw in December of 2020 to keep its head above water. So the real question is, and for investors who are looking to buy the company right now, is when will Air Canada recover, if ever? So obviously here in Canada, you will be very hard pressed to find a company that was hit harder by the pandemic than Air Canada. There is no questioning that. And investors with a bullish attitude towards this company seem to think that once COVID-19 has subsided, travel will get back to normal and it will just be operations as usual for Air Canada. And we've heard right from the company themselves that this is not the case. It will take them multiple years. Quite possibly you're looking at the end of 2023, 2024 until they return to pre-COVID revenue. This is a short to mid-term big issue for somebody who's looking to invest in the company today. At least it should be a big issue, because with them adding all this debt, they're going to have to pay it off somehow. And if they're not generating revenue, this becomes a big issue. If someone loses their job and is paying their rent with a credit card, they still have to pay that credit card back. This isn't a situation where Air Canada just comes out of this unscathed financially, and it is going to take them time to recover. Now, when I speak on Air Canada, I am speaking on it from a company level. I am fully aware that a news of more vaccines or news of flights being opened up to particular regions could cause Air Canada's stock price to shoot up. We already saw it with a company with similar exposure to the airlines and CAE shoot up in early November when news of the vaccine has come out, but that stock has since corrected nearly 20%. If Air Canada's stock price decides to launch in the short term, it is likely not a true indication of the financial health of this company. That is going to take a while to recover. There is no questioning. And moving forward today, I think there is stocks on the TSX that could provide you with better returns than Air Canada will moving forward. That's just my overall opinion on the company. I'm not as bearish on Air Canada as I am on Cineplex because I do expect flights and flying in general to get back to normal levels, whereas the cinema industry I expect to continue to be a declining industry. But there is no question that Air Canada is going to take some time to get back into shape. So overall, everybody, I think there was much better options back in August than Cineplex, and there will be much better options moving forward than Cineplex today. I don't like the company. I never really have liked the company. This is not just a bearish thesis based on COVID. As far as Air Canada goes, they're in some pretty rough financial shape. I would expect them to recover, but I, again, think that there is stronger options here in Canada than taking flyers out on a couple companies like these that are significantly impacted financially. But again, I want your opinion. Head down below and drop a comment. Do you own Air Canada or Cineplex? What are you thinking about doing with them? Do you think they'll outperform moving forward, or do you think there's more disruptive, better companies to purchase today? Again, like the video, subscribe to the channel, and we'll see you next time with more great Canadian content.